Really? First quarter of 2025 is literally about to end, which means tax season 2025 is here, and it seems like time flew by that quickly. By now, if you own an S-Corp, your taxes should be already filed. The April 15th deadline is still on though, and if you are not even close to being ready for it, or panicking because you don't even know where to start, this video may be helpful for you. Every year, millions of Americans scramble to get their taxes at the last minute, leaving money on the table, or worse, owing way more than expected. And I get it, the information out there is so skewed and not a lot of people really share what business owners like yourself should be doing to prepare for taxes. The result? So many entrepreneurs and business owners are panicking, dreading, and thinking that the tax season equals the world is ending. But really, all it needs is solid preparation if you already have a trusted bookkeeper who helps keep your books in order, and that's it. You're well on your way to success. Now, today, I'm walking you through everything you need to prepare for the 2025 tax season, the latest IRS updates, and the common mistakes to avoid, and how to legally maximize your deductions so you don't overpay. So by the end of this video, you will have a step-by-step action plan to file your taxes accurately, on time, and with way less stress. So grab a notebook or save this video because this is going to save you time, money, and frustration. Let's dive in. So step number 1, gather your documents. I noticed that the biggest mistake people make before tax season even starts is not being organized at all. Imagine sitting down all ready to file your taxes, then you suddenly realize that you're missing key documents. You're setting yourself up for frustration, panic, and let me be straight with you, chaos. So make sure to bookmark this timestamp because here's a quick checklist of what you need. So if you are self-employed or you are a business owner, first thing you need is profit and loss statement. This document summarizes your revenue, your expenses, and net income. It is super important to know what you owe. If you use QuickBooks Online, which I highly recommend, or another accounting system, you can generate this report very easily. Every dollar you spend on your business could be a write-off. So you need to make sure that profit and loss is accurate and has all the expenses that you spent running your business and on all of your projects. Your income needs to be cross-referenced as well to avoid double deposits or incorrect invoices. Some other common mistakes that I see being made are personal expenses sitting on profit and loss, vehicle expenses that belong to the vehicles that are written off using the mileage principles, incorrect breakdown of the payroll expenses, also deposits not matched to invoices, which creates double income, also missing business expenses because they were spent on personal credit cards, and so many more. I'm linking my YouTube video about the types of reports you can generate using QuickBooks below so you can follow along and find out how to create a profit and loss. Next one is balance sheet. This is a snapshot of your assets, liabilities, and equity to help assess your financial standing. If you are planning to apply for business loans, this document is important. Plus, this gives you a high-level overview of how you are doing financially. So to make sure that your balance sheet is accurate, you or your bookkeeper needs to check several things. First, that your bank accounts have been reconciled and the balances are the same as your year-end bank statements, that the list of the current assets that you own is accurate. Check for any outstanding accounts receivable to make sure no old unmatched invoices are in there. The correct balance of liabilities and interest separated from the payments, that needs to be in there. Make sure that none of the expenses and side of distributions are actually for business, and so many more depending on how you run your business. Third thing you need to provide is estimated tax payment. If you paid quarterly taxes, you need to verify that your payments match your expected tax liability, and unfortunately, if you underpaid, you may owe penalties and interest. Next one is 1099s for subcontractors. If you paid an independent contractor over $600, you're legally required to issue them a 1099. If you don't issue those forms to subs on time, here's what can happen. First of all, you will receive IRS penalties. The longer the delay, the higher the fines. So 30 days late, $120 per form. That is a lot of money. Your business could be also audited. The IRS uses 1099s to match your reported income. If you don't file, it raises a red flag that could trigger a closer look at your books. And I don't think anyone really likes IRS breathing over your shoulders. Your subs also can't file their taxes properly if they don't receive their 1099. They might report incorrect income, creating headaches for them and potentially more IRS scrutiny for you. So don't be that guy who creates this domino effect. You lost legitimate tax deductions, which are payments to subcontractors, are deductible expenses, but only if you report them. So the bottom line, file your 1099s as soon as possible to avoid penalties, audits, and unnecessary stress. Next thing you need to prepare is home office expenses. If you work from home, you might qualify for home office deduction, which allows you to deduct a portion of your rent, mortgage, utilities, and other home expenses on your taxes. However, the IRS has strict guidelines, and if you don't follow them correctly, you could face penalties or even trigger an audit. What qualifies for home office deduction? It is exclusive and regular use. The space must be used only for business and on a regular basis. It can't double as your bedroom, kids' playroom, or a part-time guest room. So the next is purchase papers for business assets. If you've purchased equipment, machinery, vehicles, or other major assets for your business, you may be eligible for valuable tax deductions, but only if you properly document your purchases. So what counts as a business asset? It is either machinery and equipment, excavators, bulldozers, generators, tools used for construction, computers and office equipment, vehicles, business use, trucks, vans. Restrictions apply for personal use. Property improvements, renovations, security systems, HVAC systems, specialized workspaces. So how can you deduct business asset purchases? Well, Section 179 deduction, that is an immediate write-off. So under that section of the tax code, you can deduct the full cost of qualifying assets in the year you buy them instead of depreciating them over several years. This is a huge for business that want to lower their taxable income fast. Here's an example to put it simply. Say you purchased a $50,000 excavator for your construction business in January of 2024. Well, instead of deducting a portion each year, Section 179 allows you to deduct the full $50,000 in the same year, significantly reducing your tax bill. The requirements for that section is the asset must be purchased and put into use before December 31st of the tax year. It must be used for businesses at least 50% of the time. The deduction phases out if total asset purchases exceed the IRS limit, which changes yearly. So number 2 is bonus depreciation. So if Section 179 doesn't apply, if you don't qualify for that, your purchase exceeds the deduction limit, you can still benefit from bonus depreciation. This allows you to immediately deduct a large portion of an asset's cost instead of spreading it over several years. For example, you buy $100,000 in heavy equipment, but only qualify for $50,000 Section 179 deduction. You may still be able to depreciate the remaining $50,000 using bonus depreciation rules. And the third method is regular depreciation, so spread over several years. So for instance, a warehouse renovation costing $200,000 may need to be depreciated over 39 years, real estate property rules. So why is it important to keep purchase records on hand? Well, proof of purchase for IRS audits. If you can't provide receipts or purchase contracts, the IRS can deny your deduction. Tracking asset depreciation. If you depreciate assets over multiple years, you need accurate records for each tax year. Business versus personal use. If you use the asset for both business and personal purposes, you'll need documentation to show what percentage was for business. What documents should you keep? Most definitely receipts and invoices showing purchase price, date, and vendor. Your loan or lease agreements. If financed, keep payment records. Also titles and registration for business vehicles or large equipment. Insurance records prove that the asset is covered under business insurance. And the final tip here, before making a large business purchase, consult a tax professional to determine whether you should write it off immediately or depreciate over time. The right strategy can save you thousands on taxes. Next one is W-2s and other payroll reports. If you run a payroll for yourself or your employees, your CPA may want to see the copies of the W-2s, which you can retrieve from your payroll software or your bookkeeper. Next thing is mileage. Make sure to provide your CPA with a log of miles spent on business vehicle, driving for the year for each vehicle that you picked that deduction for. There are many other documents your CPA may request to make sure everything is accurate on your balance sheet. As we work with our clients' CPAs, we are usually the ones to provide accurate financial statements and answer any questions that the CPAs may have for us. So if you feel like you still need to get your books in order, reach out to us and we will get them all cleaned up and delivered to your CPA. The link to schedule a call is in the description. So step 2, understand 2025 tax changes. I know that was a lot, but now that you know what documents to prepare, trust me, it's so much better and easier if you over-prepare than scramble for paperwork. So now it's time to understand the tax changes for this year. So the IRS adjusts tax brackets, deductions, and policies every year. Here's what's new. The tax bracket adjustments happen due to inflation. They have been changed slightly, which could impact how much you owe or how much you get back. Next one is lower standard deduction for some filers. So if you are married filing separately, new rules might impact how much you can deduct. New IRS reporting requirements. So payment platforms like Venmo, PayPal, and Cash App, they will report transactions over $600, meaning more people will receive 1099-K forms for gig work and side hassles. Also, expanded clean energy credits. If you installed solar panels, bought an electric vehicle, or made energy efficient home improvement, you may qualify for biggest tax credits. Step number number 3, report all your income. So one of the biggest red flags for the IRS audit, underreported income. Here's what you need to know. For side hustles and freelance work, even if you don't receive a 1099K or 1099N EC, you're still required to report all the income earned. For rental income, if you own rental properties, the IRS expects you to report all rental earnings and expenses. For stock or crypto transactions, if you sold stocks, crypto, or NFTs, capital gains taxes apply. For gambling winnings, if you won money at the casino, fantasy sports, or even scratch-offs, really, you may owe taxes. So step number 4, maximize deductions and credits. So deductions and credits are the best way to legally reduce your tax bill. And may I highlight the word legally? While it's tempting to try to find loopholes and workarounds with your taxes, it's so much better to just do everything the right way so you can sleep soundly at night. What you could potentially save now could potentially bite you back in the future. So the top deductions are home office expenses we talked about, business-related mileage, healthcare costs, student loan interest, retirement contributions, accumulation of assets. The tax credits are earned income tax credit, helps low to moderate income earners, child tax credit, a credit for parents with qualifying dependents, education credits. If you pay tuition or student loans, you may qualify for credits. Retirement contributions, if you contribute 401k or IRA, you can lower your taxable income. Review last year's return. If you had carryover losses, you may still be able to use them to offset this year's income. Talk to your CPA or get a tax strategist help to make sure you're maximizing your deduction potential. Step number 5, avoid last-minute mistakes. Last but not least, here's how you can avoid last-minute mistakes. Double check your routing and account numbers to avoid delayed refunds. The last thing you want is having the incorrect direct deposit information. Filing date. The deadline is April 15th. Need more time? You can file and request for an extension, but pay what you owe to avoid penalties. Falling for tax scams. The IRS will never call you, text, or email about payment. If someone does, it's a scam. Don't go for it. So there you have it, your step-by-step guide to preparing for 2025 tax season. Now I want to hear from you. Have you started getting your taxes in order, or are you waiting until April 14th? Drop a comment below. And if you want more financial tips and strategies, make sure to subscribe and stay tuned for the next video.